Folks, we have to break down some stocks that I believe are way overvalued. 3 in particular. We're going to break down some numbers very quickly. We'll take a look at the charts, and we'll go over when I would actually consider buying these stocks. So if you all find value, hit that like button. Make sure to subscribe. And of course, don't forget to get up to 15 stocks from Moomoo. It is free money, guys. Link down below. We'll talk more about that later. And now, cheers. Let's dive into it. And by the way, all these companies we're going to talk about today, they're great companies, right? They're awesome companies, strong fundamentals. They're going to be here around for a while, in my opinion, but you got to realize, guys, especially when it comes to long-term investments, price is what you pay, value is what you get. You can have a great company out there, but if you overpay for it, it's not going to do you any good. You can make an awful investment in a great company, if that makes any sense, if you overpay for that company. So let's just dive into it. The first stock in question here that I want to talk about that I believe is overvalued is Costco, ticker symbol COST, which I love Costco. I'm going to go tomorrow morning and probably spend $100, $200 at Costco, buying little things, and buying some food for the week and for the next couple of days. I'm going to go spend a bunch of money at Costco, right? But that does not mean I'm going to go spend money and buy the stock at these levels. Guys, look, the stock price is at $506 a share, and it used to be a lot higher, maybe not a lot higher, but I think the all-time high is $612, which was back from about a year ago, back from the middle of April of 2022. And yes, it has cooled off from that point, which is great, but I believe it is still overvalued. And looking here at the charts, guys, we do have a wedge, right? You see right here, higher lows being made at the same time that we're making lower highs. So at this point, although I think is overvalued, and we'll talk about why in a second here, I think this could end up being a decent trade if we end up breaking out of the wedge here on the 3-year chart. And you guys can probably see it even better on the 4-hour chart, as we clearly see it here on this time frame. So if Costco starts breaking out, let's say a 520, maybe starts breaking 530, all right, maybe I'll consider trading it at that point. But I want this more as an investment, guys. I don't want to trade Costco. Sure, I will trade it and make money on it in the short term, but I want to hold this company long term, reinvest the dividends, and just grow with the company, because long term I think it's going to do very well, but I want to get it at a cheap price. And again, I can't say it enough. Price is what you pay, value is what you get. So I'm willing to be patient, wait it out, and buy this company at levels that I like it, which we'll talk a little bit about that now. I'm really liking Costco anywhere under $400 a share, which I've mentioned before on the channel, but it's been a while since we've actually talked about Costco. I think it's a great company. I think it's recession proof, no doubt about it. It's got a great moat, all that good stuff, but I just need to see it start to go back down to that low 400 level, under 400 preferably. Honestly, at this point, I would consider buying it in the lower 400s. But at this point, let me transition over here to Yahoo Finance, guys. Give me a second. At this point, Costco's just a little bit rich. The price to earnings ratio for the last 12 months, you guys can see right here. If I zoom in a little bit, boom, trailing 12-month PE is a 37, almost a 38, with a market cap of $228 billion. So that price to earnings ratio, guys, on a company that's not growing too crazy, if we pull up the financials here and look at the revenue, yes, they're growing pretty nice. I mean, look, from 152 billion in 2019 to 166 billion in 2020 to 195. All right, they've had some great years recently, but I don't think it's great enough growth that's going to last into the future to justify that 38 price to earnings ratio for the last 12 months. Now, if it was trading at maybe a 25 price to earnings ratio, which it probably would be if it got anywhere from 350 to 400, somewhere in that ballpark, that would be way more reasonable the way I'm looking at it. And again, the company's growing pretty nicely, but I don't know how sustainable that is into the future. It could just be a couple good years. We shall see how that ends up playing out. And taking a look quickly here at the balance sheet, guys, let me actually look at this. I haven't looked at this in a while. They have total current assets of, let's see here, $32 billion, which is nutty, guys, and current liabilities of $31.9 billion. So that's a good current ratio there, slightly over 1. What's the cash looking like? $11 billion cash equivalents, and short-term investments. Not bad there. Let's see, inventory, obviously a bunch of inventory, $18 billion. You guys know their shelves are always stocked. And again, I'm going to be focusing on the next couple of quarters here. Hopefully the stock does come down, but at these levels, guys, and look at the yield. I think it's under 1%. Yeah, it's 0.8%. That's not that good. You guys see that dividend yield here. So if we can get that dividend yield up a little bit more, we get that P ratio to come down, maybe market cap 150 billion, 175, maybe a little bit less. I don't know. We'll see. That's where I'm going to consider pulling the trigger here on ticker symbol COST. Now, the next stock I want to talk about, the next company is it's Apple, guys, ticker symbol AAPL. And this might ruffle some feathers. A lot of you guys love Apple, and I love the company as well. They make great products. The company's great, but the stock price right now, I think, is a little bit frothy. And I put my money where my mouth is, right? I've been trimming Apple for quite some time at this point. If you guys remember, I'm not sure how many of you do, right? But I actually trimmed near the peak here back, when was that? In August? Yeah, that was about 10 months ago, or more like 8 months ago at this point. And I'm not kidding. I mentioned it during that time period. You guys might remember. I don't know. It doesn't matter. But I trimmed at, I think, at 172, maybe something like that. So I've had this stance for quite some time. It's a little bit frothy. There's better places to put money, in my opinion, better valuations out there. So I trimmed at 172, I believe. And I trimmed also a bit recently, I think, when I got to the 160s, maybe a couple weeks ago. And here we are at 164. I think the more and more it breaks out here, that's great for the traders. I mean, I'm a trader and a long-term investor, guys. You guys know I dabble in both. So if it keeps breaking out, hey, I might trade it, make some money, but I'm not going to be buying long-term shares. I'm not going to be doing that. In fact, I might be trimming. I might consider trimming more the higher and higher Apple gets. And at this rate, guys, I might get rid of my whole Apple position, which honestly, I don't want to do that. But I've been trimming a good amount over the past year, let's say. Year, maybe not year and a half. More like a year. But yeah, Apple's up a lot. I mean, a couple months ago, and it was at 124. You could have argued that was a good spot to buy, or, maybe just hold on. But here, guys, buying shares here, I don't think that's wise, in my opinion, at all. I could be wrong. Who knows? They have earnings coming up. This thing could plow through 180 for all we know. I have no idea. But overall, at this point, let me show you guys the stats on Apple very quickly. Let me pull this up and show you guys right now their market cap, you guys know, is very high. I mean, this thing is probably 1.9 trillion. Actually, no, what the heck am I talking about? $2.6 trillion, guys. Sheesh, I was way off on that. We can see here $2.61 trillion market cap, which is very high, let's be honest, very, very high. And their dividend yields a whopping 0.5%, which really doesn't matter. I mean, this is not a dividend-focused company, and personally, I'd rather see, the earnings stay within the business instead of them giving them to me via a dividend. Then I have to pay taxes while they pay taxes as well, so there's double taxation. So I'd rather them keep the money and not pay a dividend. But just saying, 0.5% dividend, and the PE ratio is a whopping 28. And again, we have a market cap of $2.61 trillion, which is pretty nutty if you ask me, guys. I think that's it's a little bit hot. I think that needs to come down a little bit. Me personally, I don't know. What do you guys think? Let me know in the comments. And you guys probably know, like I mentioned a minute ago, they're reporting earnings very soon here. So they're looking to do $1.43 EPS. Low estimate is about 137, high estimates $1.56, so the average is 143, and a year ago they did 152, so that is down a little bit year over year if it comes in at the average. And you guys can see here, average revenue 92 billion, low estimate 89 billion roughly, high estimate 98 billion, and a year ago they did 97 billion. Right now the sales declines expected to be 4.5% year over year. That is not good. Their revenue is going to be dipping year over year. And let's pull these financials up and see what's going on with Apple. Of course, guys, you could argue their best growth years are behind them, which they are. I mean, you can't grow 50% forever. That's impossible. That's not going to happen. But they're still growing pretty nicely from $260 billion, you guys can see in revenue in 2019. You guys see that right here, to $275 billion by 2020. Big jump in 2021. That was a big year. Oh my God, that was actually huge. From $275 billion to $365, big jump. And now it's starting to normalize again. $394 billion in 2022, and now trailing 12 months, $380 billion. And that's the thing, guys. We had such a huge jump, such a big jump in 2020 to 2021, $90 billion jump in revenue. This is going to slow down. That's why it's projected to be down 4% year over year. The comps are so hard at this point, and it might decline a little bit. Look, if revenue goes up like this, you guys know what I mean, straight line, If it dips a little bit for a year or two, then continues to shoot back up, that's still revenue growth long term, but it might take a hit in the short term is what I'm trying to get at here, because it had such a massive pop in 2020 to 2021. A lot of people don't realize that. $90 billion, guys, that is pretty nutty. So let me pull up the balance sheet. I mean, they have a great balance sheet. You guys know that. Total assets, $350 billion. Holy crap. That is insane. Total liabilities, $302 billion. All right, let's see the total current assets. They have roughly $135 billion current assets, cash equivalents of almost $50 billion. They can do so much with that, guys. It is nuts. I'm excited to see what they end up doing with that money. And we can see here total liabilities, current liabilities, $153 billion bucks. So their current ratio is actually under a 1 right now. Wow, I'm actually surprised by that. Current assets, $135 billion. Current liabilities, $153 billion. So under one for the current ratio. And it looks like here cash equivalents cannot cover the current liabilities, which isn't the best sign. I don't really like that, to be honest. But you know, we'll see how they roll with the punches, guys, moving forward. I mean, they do have a crap ton of cash, and I'm sure all their debts are at very high, low interest rates, guys. Apple is, you know, A+ at this point, right? You guys know that. They're A+. So we'll see what ends up happening with this company. I mean, obviously they have a great future, but at these levels, you know, it doesn't make the best investment, in my opinion. And of course, we can dive a lot deeper into the numbers, talk more numbers, but I want to keep this video a little bit short. It's already running long. So let's talk about the next one, which is Coca-Cola, guys. Oh, man, this one's very overvalued. $278 billion market cap. And look at this, guys. This is nuts. Their PE ratio, are you ready for this, for the trailing 12 months, is higher than Apple. Are you freaking kidding me? Almost a 30 trailing 12-month PE for Coca-Cola, for Pete's sake. And their dividend now, it used to be 4%. I mean, that's a nice big dividend. Now it's still good, 2.8%. But it's 2.8%. It's gone down so much because the share price has gone up so much, right? When a share price goes up, the dividend yield shrinks. Well, it doesn't shrink, but it becomes a smaller portion of the share price, hence the dividend yield going down. So at this point, guys, think about it. We have high yield savings accounts offering 3.9%, 4%. Apple just launched a savings account, 4.15%. Why would you invest in Coca-Cola, take on the added risk of the share prices going down, and you lose a bunch of money? Why would you invest in this to get a 2.8% dividend yield, which, let's be honest, a lot of people invest in Coke just for the dividend yield. Why would you do that when you can just go and put money in a savings account, high yield, and get 4%? It's just not going to happen. So I think overall, Coca-Cola overvalued, not just for that reason. To me, that's more of a reason to not buy the stock. I mean, just plain and simple, you're going to get, and sure, you could argue the price will continue to go up, but I think it's overvalued. I mean, do you guys remember when everybody flooded into value in the beginning of 2022 and ditched growth stocks? Yeah, they're still in this company. And at some point, we're going to get that rotation out of Coca-Cola. And I'm telling you, it's going to get nailed. It's going to get hit very hard. And it's going to come down to a much more reasonable valuation, which for a PE on Coca-Cola, guys, price to earnings, it's got to be in the teens. I mean, it's got to be 15, 16, 17. That'd be way, way, way more reasonable. And you guys can see their revenue growth is not that great. I mean, it's not that great. In 2019, you guys can see they did $37 billion. 2020, they went to $33 billion. Then in 2021, they popped to $38 billion. So in 2 years, they only grew by $1 billion revenue. And in 2022, they did well. You know, trailing 12 months, $43 billion. So it is growing a good amount there, but it's not nearly enough to justify that high price to earnings ratio. And let me see their balance sheet really quickly, guys. And by the way, if you haven't gone up to 15 stocks yet for Moomoo, what are you waiting for? Use that link down below. Open up an account. You get 1 free share of stock. And once you deposit at least $100, you get 4 more stocks, totaling 5 stocks. And if you deposit at least $1,000, are you guys ready for this? You get another 10 stocks, totaling 15 free stocks. And of course, all those links down below help out the channel. I appreciate you all as always. And with that being said, cheers. Let's talk about the balance sheet very, very quickly. So total current assets, and mind you guys, when I look at the balance sheet, the first thing I do is look at current assets over current liabilities, and we could do a deeper analysis, but we don't have enough time for these videos because we got to keep them concise, and this one's already running pretty long. So current assets, $23 billion. We have current liabilities, $19 billion. All right, not bad. So let's break that down a little bit. We have payables and accrued expenses, $17 billion. That's the bulk of it. And what else? Current debt and capital, We have $2.7 billion. Pension and other post-retirement, $1 billion. So that's all added up there. And let me see the cash. How much cash does Coca-Cola have? $11.6 billion. Not bad. So their current ratio is a little bit over a 1 right now, which is what I like to look for. So that's healthy. That's pretty good. But again, it's just overvalued. I think the price needs to come down. Maybe I'd buy it around $40, $45. I mean, it's at what, $68 now? So it's got a ways to go. It's at $64. But yeah, it's just overvalued in my opinion. And you guys can see Coca-Cola's chart is just way overextended on this, long-term, what is this, the max chart on ThinkOrSwim. It's just way overextended. So in my opinion, we have to see a sharp decline back towards $40 a share. That's where I'm looking to buy this particular stock. So with that being said, guys, I'm going to wrap up the video. A little bit longer than I thought, but hey, if you stuck till the end, let me know down below in the comments. Hit that like button. Feel free to subscribe. And don't forget to get your free money from Moomoo and from Weeble. And check out my Patreon if you guys want to be a part of the Discord chat. You want to see my charts throughout the day, my Patreon portfolio, all that good stuff is down below. And with that being said, cheers, guys. I'll catch you in the next video.